Hi students, welcome to the video on Management Accounting, chapter Cash Flow Statement. In case of company, we have discussed the statement position, that is known as balance sheet position or positional statement. Then income statement, that is profit and loss account. So from balance sheet, we know as a mirror reflects the face of a person, balance sheet reflects the financial position of the concern, showing assets on one side and liability on the other. And according to Companies Act 2013, we have to prepare the balance sheet in vertical form. First, we are taking liabilities and equity. Initial first we will take shareholders fund and will include equity, share capital, preference share capital, then reserve and surplus. Then we will take non-current liability like debentures, long-term debts. Then current liability, under current liability we will take the trade payable, that is bills payable, sundry creditor, any expenses outstanding, and income received in advance. Then on the second we will take assets, that is non-current assets. First, properties, land and building, and plant and machinery. Then goodwill, intangible assets, goodwill, patents, trademarks, copyrights. Then current assets, that is receivables, which includes bills receivable and sundry debtor. Then closing stock. Then cash and cash equivalent. Under cash and cash equivalent, write cash in hand, cash at bank, and short-term investments. Then in the income statement, we ascertain the statement of profit and loss, and we arrive the net profits. So from position statement and income statement, we are not in a position to know how much cash is generated from the business. That means how much is the inflow of cash and how much is the outflow of cash. So in order to know the inflow and outflow of cash, we have to know cash flow statement. So cash flow statement is a statement which describes the inflows of cash. That is, inflow means cash is coming to the business, or it is known as source of cash. Then outflow of cash. Outflow of cash, that is payment of cash. Cash is going outside. That is known as application or usage of cash. Then cash flow statement is a statement which describes the inflow, that is sources, and outflow means that is application or uses of cash and cash equivalent in an enterprise during a specified period of time. So it summarizes the course of changes in cash position of a business in any enterprise between dates of two balance sheets. So cash flow statement is very useful in ascertaining the ability of the enterprise to generate cash and cash equivalent and enable the user to help models or prepare models to ascertain the assets and compare the position value of the business, that is cash inflow and cash outflow during a particular period of time by any enterprise. So cash inflow includes cash and cash equivalent. So cash includes cash in hand plus short-term investments, that is cash in hand and demand deposit with bank, demand deposits with bank, and cash equivalents includes short-term investment in security or debt which can be realized within a short period of time without loss of value, short-term investments. So this is cash and cash equivalents. So cash flow statement is defined just like the role of a cement. The role of cement is to bind the wall with bricks and other construction material. Similarly, the cash flow binds the entire business activity. So cash flow generates from three activities. One is operating activity, second is investment activity, third is finance activity. So first, operating activities. Second is investment activities. Third is finance activities. So operating activity means it is generation of cash out of sale and purchase transactions, making payment of all the direct and indirect expenses and the income, both direct received in terms of cash, both direct and indirect. If there is transaction between cash and cash equivalent, then it does not have any effect on inflow or cash and cash equivalent. Then it does not have any effect in the inflow and outflow class. For example, suppose we withdraw cash from the bank. However, cash at bank will be decreased and simultaneously cash in hand is increased. So net effect is same. Cash at bank is decreased. Then cash in hand is increased. Net effect is same. So there is net generation of cash due to operating activity. That means suppose our sale is more than the purchase, and definitely there is balance of cash or funds in our hand. Then what is investment activity? When we are purchasing the fixed asset, that is land and building, plant and machinery, furniture and fittings, equipments, machineries, computers. So we will make payment in terms of check, either in terms check or on credit basis, whatever that may be. Ultimately we will make payment, that is will be outflow of cash. Similarly, when we are in need of funds, we can sell the fixed assets and it will generate cash, that is inflow of cash. Then in finance activity, in case of a company will issue shares to the public. As a result, public will subscribe for the share and there will be inflow of cash when share is issued by the public. That means the public has applied and company has allotted the share to those shareholders. Similarly, debenture. Debenture is an acknowledgement debt of the company. In case of debenture, it is the liability or debenture holders are the creditor of the company. Similarly, company is in need of funds. It will approach the financing institution, banks. Bank will finance, that is long-term debt, long-term loans, that is generation of cash, that is inflow of cash due to operating activity. When the preferential will redeem, debenture will redeem, the company will make the payment of payments. That means there will be outflow of cash. Similarly, there will be generation of cash due to repayment of debt or repayment of long-term loans to the bank. So we will discuss now operating activity. So in cash flow, it may be direct or indirect. In case of operating activity, it is of two types. One is direct method, another indirect method. One is direct method, another is indirect method. In direct method, we will consider sales, purchase, then the expenses. We will calculate the availability of funds. But indirect method will adjust from profit and loss, net profits. We will adjust from net profit. In the net profit, we will add all non-cash debits and we will deduct all non-cash credits. So, we will discuss the direct method first. In direct method, we will derive the inflow of funds due to sale. Inflow of cash due to sale. So first, if it is cash sale, directly cash will be generated. If it is credit sale, in case of credit sale, so credit sale during the particular period at opening stock of receivables. Suppose at the beginning of the year there will be opening stock of receivables. That means we have sold goods to on credit basis to our customer. We are yet to receive cash from them. That is opening stock of receivables. So opening stock of receivables includes both sundry debtor and bills receivable. Sundry debtors plus bills receivables. Then we will deduct the closing stock of receivables. Closing stock of receivables. Then we will get cash received from, that will give us cash received from customers or debtors. This is first. Then we will make payment regarding purchase. So for purchase, we will first take cost of goods sold. Then in cost of goods sold, we will add the closing stock of finished goods. That closing stock. If it is manufacturing concern, closing stock may be closing stock of raw material, closing stock of work in progress, closing stock of finished goods. But in trading organization, it is closing stock of finished goods minus opening stock. That will give us purchase on accrual basis. Purchase on accrual basis. Then we will make payment, that will be outflow cash on credit purchase. So from our supplier, we will purchase goods on credit basis, that is credit purchase from suppliers or creditors plus opening stock of trade payables, opening stock of payables, that includes both sundry creditor plus bills payable, less closing stock of payables. That will give us payment made to suppliers, that is outflow of cash. Then we will consider salary to staff. So for salary to staff, in the statement profit and loss account, we will take salaries and wages. Then we will add outstanding at the beginning, that is salary outstanding at the beginning of the year. Then we will deduct salary outstanding at the end. Outstanding at the end. That will give us outflow of cash due to salary and other payment to employees, that is outflow of cash to employees, towards payment to employees. So from inflow we will debit outflow of cash. Inflow of cash minus outflow of cash, that is net cash generated from operating activities. Net cash generated from operating activities. Then from net cash generated from operating activity, we have to pay tax to the government or income tax, sales tax or authority. So we will deduct tax, that will give us the net cash from operating activity. This is net cash from operating activity before tax, then minus tax, it will give us net cash from operating activity. Thank you for watching this video. In the next video, we will solve some problems relating to operating activity. Then we will discuss or we will prepare some videos on investment activity and lending activities.